The first day of the calendar year, if we remember, we gapped lower in this market. To close that would take a move up to 13.11 for this nearby contract.
I'm Marlon Bowling with you, and thanks for joining us here on the Comstock Report. Well, my guest today is Joe Camp of Comstock Investments as we reflect back on what was driving the markets on a Wednesday here at midweek, and it's the last full trading week before we get into a long holiday weekend. Okay, Joe, we had a mixed action once again in the grain trade, and once again you had the cattle market roaring higher while it kind of left the hogs in the dust. So let's focus first on the grain side here. It seems like everything is kind of weather related right now.
Weather is the word. It's a weather market. It's that time of the year. It's enough of a job to be a market analyst, but now trying to be a weatherman here. You look at this last month and a half, really rather excessive rainfall in so many areas. I pulled up the drought monitor here this morning and looked at the difference from the start of April, and you can see quite a bit of improvement across the heart of the country. Iowa, notably up into the upper Midwest, some drastic improvement. Northern Missouri, which we had so much worry about here coming in a month and a half to 2 months ago, all of that changes in a hurry when you get these types of showers consistent like we have. The flip of that, though, is spreading drought again in the southern plains, and so it's not for everyone. That can be why we in part saw strength for wheat, but also the planting worries for the row crops. The weather is certainly the focus as we've had this improvement, but we look ahead still this week, some wetter weather here and planting delays for those that still need to wrap up corn and soybean plantings. So still very much a weather-driven market for sure.
Well, as we head into the weekend, like you say, a lot of areas will be pretty soggy and heavy rainfall at that. However, when you look at the 6 to 10 day outlook for precip, things look like maybe on the over the horizon, I should say. Things may be drying out a bit in the northwestern half of the Corn Belt. What do you think?
Finally, that 6 to 10 day, we pull it up, every day, and it's wet, 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 and just extending this moist weather into the next several weeks. Well, it's dried out, as we can see, for a lot of the country. You mentioned not all of it because of the southeast remaining likely wetter than average. It's still a pattern where we're seeing this Gulf of Mexico moisture having a big influence as usual, but even more so lately as the jet stream has dipped lower. It blows some of that moisture up into the Midwest and the eastern Corn Belt, less of that potentially up into the middle, but still on into the east. This is a continuing pattern that we may come to see for the rest of the year, that the southeast can remain wet. There have been calls for a more active than usual hurricane season coming up, but the rest of the country could be now at risk of drying out. So we do have a drier forecast potentially up into the first part of June. We'll see if that extends itself into what is also a call for a hotter than normal summer ahead, which could be ultimately a risk of flipping from wet conditions to way too dry.
I know the Climate Prediction Center did come out with their what I call their INSO update. They do it every month, and they keep talking about the fact that we're going to switch from El Nino to La Nina by late summer. They think, 65, 85% chance, something like that, depending on what time frame you're looking at. And I guess with that in mind, you have a long-range temperature outlook here. This covers June through August. That seems to kind of reflect that. And if that's the case, that temperature map that you have is the one that concerns me, because being a farmer, I used to be subjected to what they call a flash drought. If you had a wet spring, the roots don't go down. And then if it turns out hot, like the 4th of July, the roots can't go down fast enough to find the moisture before the plant burns up. Now, looking at that temperature map, what kind of warning signs does that bring to you?
Right. You talk about filling subsoil moisture in the tank there going forward. But if you have these problems with wet planting early on, or the delayed planting in particular, and all of a sudden we get to August and this crop is being fried, it's not going to be the type of finishing weather that you have to have if you're still going to have the potential for average or above average yields. And so we are at that point where anything planted from now on later throughout most of the middle of the country is going to have this potential yield penalty, and that's only going to be racked up further as it could potentially get hotter and drier because of that outlook map you see for the summer. The meteorologists are saying, and it's linked to La Nina. Remember, we had before this last season of El Nino, basically 3 years in a row of La Nina, and that included 2021 and 2022, where we had record warm years. Now, back to that, we see that June, the call is for temperatures to lean slightly above average. In July, for them to heat up even more, and on into August, the difference from normal being very extreme. And so that's a point of concern any way you look at it, even after the wetter weather and the restoration of some subsoil moisture, some curing of that drought in areas. The risk is, as usual, we go ahead and all of a sudden the rain shuts off.
And it sounds like it's not just here that the weather is a bit of a concern when it comes to crop production. This year, parts of Europe and Asia are also not experiencing the best year right now, right?
I looked at the U.S. drought monitor and then thought, well, we're talking about dry weather in a big way for Russia and Ukraine. That's in part what's rallied the wheat market. We had until today, relaxing a little bit lower, a rally of about $1.50, more than that from low to high over just a couple days, more than a month's time. That a lot of it being tied to this talk about drought expanding in Russia and Ukraine. If you pull up then the global drought monitor, what really stands out is this really big dark red spot right in the middle of the map, as it's shown here, where Russia and Ukraine and their heaviest wheat growing regions are centered. And so we have estimates that are now dropping lower for global wheat production at a time when already we had anticipated global supply for wheat to be reduced further into this next 2024-2025 marketing season. Remember, we just got the first new crop estimates out on the May report. It did show wheat stocks shrinking further here into this next marketing year, and this is something that even exacerbates this move because of what's going on in Russia and Ukraine. It's not just dry weather. It is, as of just recently, late freeze events that not only threaten the crop that's growing, but push back and get in the way of spring plantings that were still yet to be achieved. So a lot of issues with the wheat going on abroad, and that's dry weather that can also potentially expand into the rest of Western Europe.
I'm glad you mentioned that. I just heard, I believe yesterday, about some crop scouts looking at the Russian wheat crop. And as those heads come out, they are starting to find more and more white heads where they did freeze. And, they're not going to be able to fill those berries if that's the case. You combine that with the drought stress, and it makes for a bit of a lot of pressure on the overall production here. But given the fact that we have rallied wheat for $1.50 already, what do you think? Technically, on the charts, it looks like it's really getting overheated here.
We do get to a point where the market has to say, okay, let's take a step back for one, because those prices in Russia and France were moving higher, but not necessarily quite at the same clip as the U.S. market has run. And that would leave us, relative to, say, a month ago when we started this rally, even less competitive in terms of export offers out there. And then seasonally, we know we've got some potential pressure ahead, as we brought up on the show, that would come with the harvest approaching, our winter wheat crop harvest. Relatively much better conditions from a year ago. We talked good coverage on the Kansas crop tour. We had a crop tour here in Illinois from the Illinois Wheat Association, and they estimated a yield over 100 bushels per acre. So it's a good crop potential that we've got across a lot of the Midwest for soft red wheat as well, and potentially some pressure ahead, which is why we're taking note of this recent rally and talking a lot about what we should be doing on it.
Make sure you like this video, subscribe to this video, click that bell icon down below, and make sure you share it with your friends and relatives as well. Yeah, I know in the last couple of weeks in our discussions, we have been talking about maybe rewarding the rally, maybe incrementally as we go. But man, when you add on $1.50, I just wonder if maybe people need to be taking a look at taking a bigger bite out of that overall marketing plan.
Yeah, everybody's situation is unique. So we're talking with farmers about, can you store wheat and sell into a carry market, potentially get past some of the harvest pressure for basis or quality type delivery issues. We look also at still employing a potentially scale up type of marketing strategy. So even if we can remain generally bullish on into the next month, like we generally are with the row crops as well, that it doesn't necessarily mean we can't get a really strong start ahead of this next harvest. And if prices keep going up, then great, we'll be in a better spot to sell off the combine possibly.
Trying to be a realist, I mean, you have to keep in mind combines are already rolling. I mean, new crop is going to be coming online here in short order.
Yes, and if we see continued price strength, though, even in that face of an early harvest push, that can only be a positive development for prices. It's the same thing with the row crops, where all of a sudden, farmer sales and hedge pressure is a considerable potential headwind for this market. But if the hedge funds are going to be buying back futures and eventually turning bullish at a faster rate, at least temporarily, this price can keep moving higher.
What do we do with the corn right now?
Corn, we've been cautiously poking our head in there to try to encourage old crop catch-up sales if needed and to have a small start on new crop. We're thinking a lot about hedging your risk rather than being too aggressive on forward sales, getting a bit of a better handle on what's in the ground here and how things look on into this next month of June. And then we can be at levels where, especially when we're talking about December corn futures, for example, bumping up against $5. These are levels that we want to seize upon, especially if they occur into this, again, month of June, when normally we see some topping out type of action. But we're being cautious because we don't, at the same time, want to step in front of what could potentially be a short to intermediate term trend change because of what we talked about with these hedge funds now buying out of shorts and potentially, at least briefly, wanting to turn bullish this market. But like we can talk about scaling up in terms of making smaller sales and increasing those into possibly expected higher prices.
I was looking at a July corn chart. It looks like the 50-day moving average did hold. It's holding the uptrend line, but I'm a little bit concerned that the last 2 weeks or so, I know it's a short term, but it seems like it's kind of coiling up a little bit. Does that draw a caution flag for you or not?
It is something that potentially could develop further bearish momentum divergence because we were just coming off of new highs, but not following through. I think that goes back to this same conversation of the rate at which the funds are buying back shorts and ultimately transferring these positions over to the farmers. And we saw that here on the run up to new highs for the move early in May, new successive highs later in the month. That did seem to buy a lot of grain. And in fact, those trader positions report confirm that big net short positions, the biggest that we've seen since right before the last harvest, were put on to hedge those new farmer sales. But you get to a point where, one, there's less old crop left to sell. Two, they've done enough of the early hedging for new crop. And three, if the market's rallying because we've got further weather delays, there's going to be a farmer that wants to be tighter fisted all of a sudden with what they're going to continue to sell going forward. And that's when, if those speculators continue to buy, they're going to run into less and less resistance from here. And that's when we could eventually get past some of these recent highs and on above levels that are technically very important.
On the other hand, soybeans, July soybeans are hanging on to a very sharp uptrend line. Big gains once again today on Wednesday, outpacing November soybeans to the upside. And I'm a little bit surprised to see action like that because the harvest in South America Heck, in Brazil, it's almost winding up. Doesn't that mean the market is awash in beans right now?
Normally, you would talk a lot about harvest pressure coming online from the South America's harvest and the bearishness related to, for example, these USDA estimates just sticking at relatively high levels, certainly relative to the rest of the trade, relative to CONAB, Brazil's crop agency. Yet we let the price, really show us what's going on. And even with the harvest pressure, all of those beans filling the pipeline, the boats leaving the ports, we're seeing Brazilian offer prices move higher. The same could be said for those prices from Argentina. And all of a sudden, after a really sluggish period for soybean exports out of the U.S., we're getting some signs of interest, even including that from China, a talk of the week here that China is potentially feeling out and purchasing some bushels to be shipped out of the Pacific Northwest. If it's the case that China all of a sudden steps in and wants to be a buyer of U.S. beans over the summer months when we're actually coming down, to the tail end of what's still available from the last harvest, and when we're still relatively tight-fisted on new crop sales, given that the market currently is discounted out to that forward crop month as it is, you could see that being a more bullish storyline. But we'll pump the brakes and, at least for now, wait and see whether or not those export sales can steadily improve from here. One thing that we don't have here this summer, like we usually do have to deal with, is that unshipped sales of soybeans are rather minimal, and that's not a risk that we have like normal, that China steps in during the summer months and cancels a bunch of their previous purchases that were made at much higher levels. Instead, they can be in a position where they actually come in and make some late season purchases, which would be certainly friendly.
And again, on the July beans, one thing, it's in that uptrending line, holding true to that. However, now today, here it is right at the 38% retracement line too. So it appears that it's decision time, right?
Yes, you look at where it topped out again today, just a quarter of a cent below 12.50. We briefly pushed beyond that mark this week, but you can imagine there are a lot of offers stacked up around that key level. The next big one not being until you get to around $13 even. Before then, you do have, because you mentioned the Fibonacci retracement level, another key one of those at 12.81, and then above $13. If you can push past that, everybody's still keeping an eye on that gap that's on the charts. The first day of the calendar year, if we remember, we gapped lower in this market. To close that would take a move up to 13.11 for this nearby contract.
Time to shift gears. We'll talk livestock. Cattle are at it again today. You have to be impressed by the way they can continue to roll upward the way they are here. It seems like a juggernaut right now.
It got to be on the way down. We were saying, well, we have to keep in mind that there's a difference between the supply and demand of futures and the headline risk and the speculative positioning as opposed to where the cash market is trading. And the gap had gotten to be so wide that when you did not have a break lower, and in fact, another push higher for cash markets, the futures market eventually responded. And why did cash markets move higher? Well, it's the basically historical surge that we had in beef prices here last week, coming up through last Friday. The choice beef average jumping almost $19 per hundredweight, firmly hurtling above that $3 mark, and just really holding steady now this week to make us positive about what's ahead again for the cash trade in a market that's still discounted to where we think most of this business is going to land again this week. And so that's all of a sudden really a friendly development again for cattle futures at a time when, at least for now, we don't have this same influx of headline risk like we did these last 4 to 6 weeks over the bird flu.
Looks like right now we're within 1 day's trade of achieving that March high.
We're going to be advancing towards this March high, and above that, not much above the market until you get back to those all-time highs from last year. But we still talk about, dress cattle prices above 300, still another, $25, $26 before we could get to some of the highest levels achieved last year. That leaves at least some room where we could look towards a further rally. And at the same time, we're further enough along into the spring season, entering the summer, where we could start to get some seasonal type of pushback here. But yeah, it's all pretty positive news right now for the cattle.
And again, just the opposite on lean hogs. You have them taking out the 62% retracement line, and it looks kind of dire now. I mean, now below that, there isn't a whole lot of support.
Yeah, and I was going to say just the opposite for the hogs as well, because of the hog future still being above the cash trade in most respects. Any average you look at going to be at least $2 or $3 below where the nearby board contract is, and that's been a source of pressure here as of late. And then to the technicals that you mentioned, yeah, that 62% retracement did not hold here today. You have, I think, technically still a potential extension of selling from this double top formation. That was one chart I wanted to bring up because of how pronounced that failed new high attempt was. So just the basics would be, let's measure that move down from the previous high, that low being breached. If you extended it by that same amount, we're looking at July hogs potentially down to somewhere around $94. That's still $3.5 we could see this market break if we're just measuring out some of the basic technical ramifications. I think eventually, though, such a sharp slide in such a short amount of time, like if you go back to the cattle and the way we feel about beef, I don't think we're too negative about how consumers are going to be treating pork here as we open up the summer. So I think we don't necessarily have to go all the way down to some of those more bearish technical levels before, at least temporarily, we can find some support here soon.
And on that July hog chart that you provided here that we're looking at, the red Bollinger Band there, it's just hugging the bottom end of that right now. So that is kind of critical support right there. Joel, great to talk with you again. Thank you for all the info. I hope you have a good rest of the trading week. Joel Camp with us. He is with Comstock Investments. That'll do it for this episode. Thanks for tuning in. For our producer, Breanne Hendrickson, I'm Marlon Bowling. We'll catch you next time right here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.